Every time a generational founder steps away from, the empire they built,
Yeah.
the entire financial world just kind of holds its collective breath.
Oh, absolutely. They expect chaos.
Right. You usually see this massive scramble for identity. A new CEO comes in, they want to make their mark, so they inevitably initiate some flashy acquisition, or they try to reinvent the corporate wheel just to prove they're in charge.
Yeah. The market always anticipates vulnerability in those moments. Because when Warren Buffett retired at the end of 2025, at the age of 95, the overwhelming assumption was that Berkshire Hathaway would undergo this period of philosophical turbulence.
Which is a totally fair assumption,
Yeah.
right? I mean, you have a company managing hundreds of billions of dollars, and the defining architect of that wealth is just no longer at the helm.
Exactly. It's a huge shift.
But so we are now in the spring of 2026, and that whole narrative of turbulence has been completely shattered.
Complete.
Because the new CEO, Greg Abel, just released Berkshire's Q1 2026 13F filing. And looking at the moves they made over the last 90 days, we are seeing a corporate landscape that is just breathtaking in its discipline.
It really is. It's a total masterclass in capital allocation during a massive transition. It forces a complete reevaluation of what leadership actually looks like at that scale.
Yeah, because Greg Abel isn't trying to do, like, a Warren Buffett impression.
No, not at all. He is implementing what the market is already calling the Abel Shuffle, and he is doing it with absolute ruthlessness.
And we're going to decode exactly what that shuffle looks like today on this deep dive. We're breaking down how Abel is managing a record-breaking $397.4 billion cash pile, and how he's radically shifting the equity portfolio away from traditional tech and open payments toward, well, modern utilities and digital toll bridges.
It's a fascinating pivot.
It really is. But before we dive into the Abel Shuffle, a quick reminder on how you can access our deeper research. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store. Disclaimer: all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for information and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you would like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.
That context is actually really essential, especially given the sheer scale of the numbers we are about to discuss today.
Yeah, the numbers are wild.
If you want to visualize the mindset behind this filing, you sort of have to picture a modern corporate strategy room, right? But built inside a classic wood-paneled library.
Oh, I like that image.
Right. The fundamental principles of value investing are still lining the shelves. They haven't changed. But the screens on the walls are tracking a highly volatile, AI-driven global economy.
Okay, so let's start with the loudest number in that strategy room, the cash.
The elephant in the room.
It is almost impossible to wrap your head around this figure. It's $397.4 billion in pure cash reserves.
Just staggering.
For everyone listening, that represents 59% of Berkshire's entire investable portfolio.
Right, and historically, they have comfortably sat around a 30% average, so they have essentially doubled the weight of their cash.
Which is wild. And when analysts see a number that large, the immediate cynical reaction is to assume paralysis, right?
Oh, yeah. The critique is always that Berkshire has lost its edge or that they have no idea what to buy. People argue this mountain of capital is just a drag on their overall performance.
But that betrays a fundamental misunderstanding of the actual mechanism at play here.
Yeah.
Because here's where it gets really interesting.
Okay, lay it out.
Out of that $397.4 billion total, $339.3 billion is parked specifically in short-term U.S. Treasury bills.
Yes.
So holding cash in this environment isn't like shoving it under a mattress where inflation just eats it alive. It is a coiled spring.
That's a great way to put it.
And because of the yield on those T-bills, the U.S. government is funding the tension on that spring. Berkshire is pulling in nearly $1 billion every single quarter in interest income.
It's crazy.
They're essentially being paid $1 billion every 90 days to patiently sit there and wait for a market panic.
And if we connect this to the bigger picture, the strategy is anchored by the concept of the hurdle rate.
Okay, remind everyone what exactly that means in this context.
Sure, a hurdle rate is just the minimum return a company requires before they will risk deploying capital into an investment. And Abel is surveying a market defined by, well, gambling enthusiasm right now.
Yeah, the multiples are totally stretched.
Exactly. Look at the valuations. You have Chevron trading at 31 times its earnings, or Apple carrying a PE ratio of 36.
Okay, let's unpack this for a second because that PE metric is crucial for this whole deep dive. A price-to-earnings ratio of 36 basically means you are paying $36 for every $1 of profit the company generates, right?
Right, which is extremely expensive.
So if the business doesn't grow at some explosive rate, it would theoretically take you 36 years just to make your money back.
And that is the exact mathematical reality Abel is looking at. Why would he accept the massive operational and market risk of buying into a company at a 36 multiple when he can accept virtually zero risk in short-term government debt and generate $1 billion every quarter?
Right.
The hurdle to justify buying a stock right now is incredibly high. He is flat out refusing to participate in the momentum trades.
So the default state is just collecting $1 billion a quarter.
Yep, not a bad default state.
Not at all. But if the bar to deploy capital is set that aggressively high, the moves they actually did make, the assets that actually clear that hurdle, become the most fascinating part of this.
Whoa, absolutely. Because what they bought and sold in Q1 is legitimately shocking.
Yeah, they were active. They were a net seller overall, offloading about $24.09 billion in stock and buying $15.94 billion.
Right, and the specific targets of those trades signal a profound shift in how Berkshire views economic durability in the 2020s.
The tech pivot is the wildest part of this to me. Like, they completely liquidated their position in Amazon. Not a trim, a total exit.
Completely gone.
But simultaneously, they added 58 million shares of Alphabet, tripling down to create a $17 billion stake in Google's parent company.
It's a huge statement.
They jumped one member of the Magnificent Seven just to back up the truck on another. Why the complete 180 there?
The divergence there centers entirely on the concept of capital expenditures, or CapEx, specifically in the era of artificial intelligence.
Okay, so it's an AI play.
Well, it's an AI risk mitigation play. Berkshire looked at Amazon's roadmap, which currently involves spending roughly $200 billion on physical AI infrastructure and these sprawling, massive data centers.
$200 billion, that's just wild.
Right, and they categorize that entire endeavor as, quote-unquote, too hard.
Too hard meaning what, exactly? That the physical hardware required for AI is just a depreciating trap.
Precisely. Depreciation is the silent killer of those returns. Think about it. AI chips and data center servers are not durable assets.
They age out incredibly fast.
Exactly. A $200 billion physical infrastructure investment today will be technologically obsolete in 36 to 48 months. It is an endless, brutal hardware treadmill.
Wow. So Amazon is basically forced to spend billions constantly just to maintain their current market position, let alone actually grow it.
You nailed it. And Abel looked at that massive, constant cash burn and decided the long-term returns were simply too speculative.
Contrast that with Alphabet, though. To use an analogy, investing in Amazon right now is kind of like trying to build the most expensive, top-of-the-line smartphone every single year, knowing it's going to be useless soon.
Right.
But investing in Alphabet is like owning the cellular grid itself.
That's a perfect way to look at it. Google's search and cloud model just doesn't require the same relentless physical infrastructure churn. It's a highly capital-efficient software moat.
So they view Alphabet's search dominance as a toll bridge.
Yes. The pathway for Google to monetize AI is integrated directly into software services that people and businesses already rely on daily. It requires significantly less fresh capital to maintain that dominance compared to building warehouses full of servers.
Okay, so moving from the physical hardware treadmill to a software toll bridge makes total sense. But that logic actually brings me to a massive contradiction I noticed in their payments pivot.
Ah, the credit cards.
Yeah, they dumped a combined $4.8 billion stake in Visa and MasterCard.
Yeah.
And the reasoning cited was fears over fintech disruption and blockchain technology threatening those networks.
Which is a valid fear.
It is. Yet they held on to American Express, which remains a colossal 17.43% weight in their portfolio.
It's a huge position.
So my question is, aren't Visa, MasterCard, and American Express all just plastic credit cards facing the exact same fintech threats?
See, they appear identical to the consumer pulling them out of a wallet, but architecturally, they are entirely different businesses.
Okay, break that down for us.
Visa and MasterCard operate what the industry calls open payment rails.
Open rails.
Right. They do not issue credit, and they do not hold the customer deposits. They are strictly the digital pipes connecting your personal bank to the merchant's bank.
So they are essentially just a digital middleman taking a fraction of a cent every time the pipe is used.
Exactly. And they've been a highly profitable middleman historically. However, as digital wallets, unified ledger technology, and faster bank-to-bank settlement systems develop, cheaper alternative pipes are being built.
Oh, I see.
Yeah, if a merchant can avoid Visa's routing fee by using a cheaper fintech pipe, Visa's economic moat begins to just evaporate.
Okay, I follow that. The open pipe is vulnerable to new tech.
Yeah.
But how is American Express any different? I mean, I can use Apple Pay to tap an Amex card, just like I can tap a Visa.
The difference is that American Express operates a closed-loop network.
Closed loop, meaning they own the whole process.
Exactly. Amex is the bank issuing the card. They are the network processing the transaction, and they manage the relationship directly with the merchant.
Wow.
There are no other banks taking a slice of the pie. They capture the entire economic spread of every single swipe. Even if you use Apple Pay, you are still interacting entirely within Amex's closed ecosystem.
And because they control the entire loop, they control the customer data and the rewards program directly, right?
Yes. And that control results in a massive demographic moat. Amex actively curates a premium, high-spending user base.
Right, the classic Amex customer.
Exactly. Merchants accept Amex's higher swipe fees because they desperately want access to those specific high-net-worth customers.
So the data backs this up.
The data from Q1 is staggering. Amex saw an 11% volume growth, processing $486.3 billion in a single quarter.
Which generated a 35.2% return on equity.
Yeah.
I mean, that is the kind of durable profitability that totally explains why Abel views open rails as a risk, but a closed-loop system as a fortress.
A digital fortress, absolutely. But to your earlier point about toll bridges, Berkshire didn't just restrict this philosophy to software and payments.
Right.
They applied this exact same logic to physical infrastructure, making a very unexpected entry into the airline industry.
Which feels like a contradiction of legendary proportions. I mean, Warren Buffett famously liquidated Berkshire's entire airline portfolio during the 2020 pandemic crash.
He did, very publicly.
He declared the industry a terrible place to park capital. Yet, in this 13F, Greg Abel initiated a brand new $2.65 billion stake in Delta Airlines.
Yeah, it definitely raised some eyebrows, but it requires a close look at Delta's specific operational mechanics to understand why they cleared Abel's hurdle rate when literally every other airline failed.
Okay, so what's the secret sauce for Delta?
Well, airlines are typically terrible businesses because their highest input cost, which is jet fuel, is completely out of their control.
Right, it's just dictated by global crude oil markets.
Exactly. But Delta eliminated that vulnerability.
Right, because Delta actually owns an oil refinery in Pennsylvania.
Yes.
They can hedge their own jet fuel costs internally, which is an operational advantage no other major U.S. airline possesses. And that alone helped them hit a record Q1 revenue of $13.2 billion.
The refinery isolates them from commodity shocks, which is huge. But the true linchpin of this investment ties directly back to our previous discussion on closed-loop ecosystems.
The American Express partnership.
You got it. Delta generates over $2 billion in pure high-margin revenue every single year solely from their co-branded credit card partnership with American Express.
Wow. So what does this all mean for Berkshire's philosophy? It means they aren't looking at Delta as a commodity transportation service where customers just use a search engine to find the cheapest seat.
No, not at all.
Delta is essentially the Apple of airlines. It is a premium, sticky ecosystem. You fly Delta to get the Amex miles, you use the Amex to get the Delta lounge access, and the entire closed loop generates massive free cash flow.
And what's fascinating here is how seamlessly that sticky ecosystem concept transitions to their media investments.
So this one was wild.
They shocked analysts by increasing their stake in the New York Times by 199%.
That's a massive jump.
Yeah, they bought 15.15 million shares, bringing the position to $1.27 billion.
I have to admit, seeing a newspaper on a 2026 investment sheet felt like a typo at first glance.
If you evaluate the New York Times as a print newspaper, the investment makes absolutely zero sense. But Abel evaluates it as a digital subscription utility.
A utility.
Right. They operate with $0 in long-term debt and command a 49% gross margin.
Almost 50% margin on news.
Well, see, that's the thing. Furthermore, they've perfected the bundle. Subscribers aren't just paying for political news anymore. They are hooked on the cooking app, the daily games like Wordle, the sports coverage via The Athletic.
It's an anti-churn mechanism.
Exactly.
You might get tired of reading the news or you just want to break from politics, but you keep paying this subscription because you don't want to lose your recipe box or your crossword streaks.
The retention is phenomenal because of that. But there is a deeper philosophical moat here regarding artificial intelligence.
How so?
As the internet becomes aggressively flooded with AI-generated noise, hallucinated articles, and deepfakes, the value of verified human-curated reality just skyrockets. High-trust intelligence becomes a incredibly scarce commodity.
So the New York Times basically acts as a digital toll road on truth.
Yes.
If you want verified facts in a sea of algorithmic garbage, you have to pay the toll. Whether it's the search toll with Google, the commerce toll with Amex, the travel toll with Delta, or the truth toll with the Times, The strategy is brilliantly cohesive.
It is entirely cohesive,
Yeah.
which forces us to look at the actual management style driving this cohesion. We are seeing a distinct transition from Warren Buffett's intuition-based, highly personal management style to Greg Abel's systemic operational discipline.
Right. We hear a lot about the Abel standard inside the company walls now. How does that practically differ from Buffett's approach on a day-to-day basis?
Well, Abel is a fiercely pragmatic operator. He has publicly declared war on what he labels the ABC of corporate decay:
The ABC, which is...
arrogance, bureaucracy, and complacency.
Oh, I like that.
Buffett allowed his subsidiary managers a massive amount of autonomous leeway. He relied on his personal judge of their character. Abel is much more focused on strict operational metrics and ruthless efficiency.
So less about the handshake, more about the spreadsheet.
Essentially, if a business unit isn't hitting its margin targets, the bureaucracy is getting stripped out immediately.
But importantly, he isn't tearing up the foundation. The forever holdings that really define Berkshire are still intact. Apple remains the undisputed king of the portfolio, sitting at a 21.99% weight, valued at roughly $57.84 billion.
Right. They did trim the position slightly, probably due to that 36 PE ratio we discussed earlier, but the underlying business is just too strong to abandon.
Yeah, you do not fully liquidate a company generating a 141.47% return on equity.
We should definitely define that for everyone listening, because an ROE of 141% sounds like a typo.
It really does. Return on equity basically measures how efficiently a company generates profit from the money shareholders have invested. A normal, healthy company might have an ROE of like 15%.
Right, 15 is considered good.
So Apple's 141% means that for every single dollar of equity, they are generating $1.41 in pure profit year after year.
It is a perpetual motion machine of cash generation. And that foundational stability extends to their legacy holdings too, like Bank of America and Coca-Cola.
Yeah, Coke is basically a dividend king that maintains a 35% operating margin just by selling flavored water.
Exactly. Those businesses are the absolute bedrock.
Yeah.
But the true engine of Berkshire, the mechanism that actually allows Greg Abel to sit on $397 billion in cash and just ignore all market pressure, is the insurance float.
Ah, the float. The float is the secret sauce. Ajit Jain manages this operation, and it is vital to understand how it works if you want to understand Berkshire.
Break it down.
When you pay your auto or property insurance premium every month, the insurance company holds that cash before they eventually have to pay it out in claims, right? That pool of held money is called the float. Berkshire gets to take that massive pool of other people's money and invest it for their own profit.
Which is incredible.
And right now, Berkshire's float sits at $176.9 billion.
It is essentially an enormous interest-free loan from their policyholders. And the underwriting discipline of Ajit Jain's team is so unbelievably precise that in Q1 alone, the insurance operations drove $11.3 billion in operating profit.
Just stop and think about the scale of that for a second. Imagine running a company that throws off $11.3 billion in pure operating profit in 90 days.
Totally independent of what the stock market is doing.
Exactly. If you have that kind of engine generating a permanent free source of capital, you are never, ever forced to sell a stock in a downturn just to cover your bills.
And this raises an important question regarding portfolio theory. Traditional finance teaches you to diversify to protect your wealth, right?
Like, don't put all your eggs in one basket.
Exactly. So a lot of analysts assumed a new CEO might come in, get nervous about the size of the portfolio, and start spreading the capital across hundreds of different safe bets. Abel looked at that $11.3 billion engine and did the exact opposite.
He leaned straight into the conviction model.
Heavily. The top 5 equity holdings in Berkshire's portfolio now make up 67.1% of their entire stock market exposure.
Nearly 70% of hundreds of billions of dollars concentrated into just 5 core ideas.
He is not diversifying. He is amplifying his absolute best ideas.
Which requires an unbelievable level of psychological discipline.
Yeah.
He is strictly making adjustments around the edges, cutting out the depreciating AI hardware risks of Amazon, locking in the durable digital toll bridges of Google and Amex, and just letting the massive profitable engines of Apple and the insurance businesses run completely unhindered.
That is the Abel standard in practice. Maximize the moats, eliminate the capital expenditure drains, and concentrate the capital where the pricing power is absolute.
So to pull all of this together for you, Berkshire Hathaway, under Greg Abel, is leaner, it is hyper-liquid with nearly $400 billion in cash, and it is absolutely ruthless about a future.
They are no longer interested in companies that have to spend billions just to survive the AI revolution.
Exactly. They only want the toll bridges. The ecosystems that are so deeply embedded in our lives, travel, payments, search, and truth, that we basically have no choice but to pay the toll.
And the power of this deep dive isn't just in analyzing what billionaires are doing. It is about applying that exact same framework to your own decisions.
Oh, that's a great point.
Right. You don't need a massive cash pile to ask the hard questions about your own life or your own business. Do you possess an economic moat in your career? Are you holding on to a strategy simply because it worked in the past or because it actually possesses future durability?
Are you exhausting your resources on depreciating hardware, or are you building a sticky, valuable ecosystem?
Exactly. Evaluating the durability of your own toll bridges.
I love that application. And that leaves us with one final lingering thought to chew on as we wrap up this deep dive. We started by looking at that massive coiled spring of cash.
The 397 billion.
Yeah. If the greatest capital compounding machine in financial history looks at the current AI revolution, analyzes the stretched market multiples, and decides that the absolute smartest bet they can make is to sit on $397 billion in government T-bills and patiently wait.
Wow.
What does that say about the level of risk everyday investors are unknowingly taking right now in the stock market?
When the most successful capital allocators in the world are quite literally being paid $1 billion a quarter just to be patient, it usually pays to pay attention to their silence.
A sobering perspective to end on. Keep digging deep into your own moats. Stay disciplined in your own capital allocation, and we'll be right here to decode the market when that coiled spring finally releases.